In the vast and intricate web of global finance, where banks and traditional financial institutions play a prominent role, there exists a parallel universe known as the shadow banking system. This system operates largely outside the regulatory framework that governs conventional banks, yet its influence on global economics is profound and far-reaching. The term shadow banking might evoke images of illicit activities or clandestine operations, but in reality, it encompasses a wide range of financial entities and mechanisms. These include hedge funds, private equity firms, money market funds, structured investment vehicles, and other non-bank financial intermediaries that facilitate credit creation and liquidity in the financial markets. Unlike traditional banks, which are subject to stringent regulatory oversight and capital requirements, shadow banks operate with greater flexibility, often using innovative financial instruments and complex structures to achieve their objectives. One of the primary reasons for the rise of shadow banking is the search for higher yields in a low interest rate environment. Traditional banks, constrained by regulations, are often unable to offer attractive returns on deposits and investments. Shadow banks, with their ability to take on higher risks, can provide more lucrative opportunities for investors seeking better returns. This has led to the proliferation of shadow banking activities, especially in times of economic uncertainty or financial repression. The shadow banking system plays a crucial role in providing credit to the economy, especially to sectors and borrowers that might be underserved by traditional banks. For instance, small and medium-sized enterprises, SMEs, which are often deemed too risky by conventional lenders, might find funding through shadow banking channels. Similarly, consumers with subprime credit ratings might turn to shadow banks for loans that would otherwise be unavailable to them. However, the very characteristics that make shadow banking attractive also pose significant risks. The lack of regulatory oversight means that shadow banks can engage in highly leveraged and speculative activities, which can lead to financial instability. The 2008 global financial crisis highlighted the dangers of unchecked shadow banking, as many of the entities involved in the crisis were operating in the shadowy realm. The collapse of Lehman Brothers, for example, was precipitated by its heavy involvement in shadow banking activities, particularly in the repurchase agreement, repo, market, and mortgage-backed securities. The interconnectedness of shadow banking entities with the broader financial system means that distress within the shadow banking sector can quickly spread, leading to systemic crises. The opacity and complexity of shadow banking operations often make it difficult for regulators and market participants to assess the true extent of risks involved. This can lead to sudden and severe market disruptions when hidden vulnerabilities come to light. In response to these risks, regulatory bodies around the world have been taking steps to bring more transparency and oversight to the shadow banking system. Initiatives, such as the Financial Stability Board's efforts to monitor and regulate shadow banking activities, aim to mitigate systemic risks and enhance the resilience of the financial system. However, striking the right balance between regulation and innovation remains a challenging task, as excessive regulation could stifle the very benefits that shadow banking brings to the economy. Despite the risks, the shadow banking system continues to evolve and adapt, driven by technological advancements and changing market dynamics. The rise of fintech and digital platforms has introduced new players and models into the shadow banking landscape, further blurring the lines between traditional and non-traditional finance. Peer-to-peer lending, crowdfunding, and cryptocurrency-based financial services are just a few examples of how technology is reshaping the shadow banking sector. As the shadow banking system becomes more integrated with the broader financial ecosystem, its influence on global economics is likely to grow. Policymakers, regulators, and market participants must remain vigilant and proactive in understanding and addressing the complexities of this hidden world. By doing so, they can harness the benefits of shadow banking while mitigating its potential risks, ensuring a more stable and inclusive financial system for all. The continued evolution of shadow banking underscores the dynamic nature of global finance, where innovation and risk constantly interplay, shaping the economic landscape in ways that are both seen and unseen. Comment with your favorite fact. With your favorite